All right, folks, and welcome to the continuation of our introduction to financial modeling. And as you can see here on my screen, this is where we last left off in our previous video lecture. And we had calculated our working capital ratios, which we're going to use to forecast our current assets and current liabilities, which would give us the driving numbers that we actually need to forecast our balance sheet. But before we do that, let's just recap what we've done up to this point. So let me scroll up here to the income statement. So if you remember in the previous video lecture, we ended up first calculating our historical numbers for 2018 to give us a better sense of our cost of goods sold margins, our gross profit, SG&A, effective tax rate, just ultimately to arrive to a net income value. Then we use the percentages or the margins associated with the cost of the business to forecast our expenses. Which expenses? Cost of goods sold, SG&A. In addition to that, from a top line number, we're specifically talking about revenue. We derive revenue from two variables, price and volume. The main driving number was 2%, as you can see right here, which was increasing, or it's increasing our price. So we're assuming that it's growing at 2%, which is traditionally the rate of inflation given the US economy. And these were the main driving factors, or the main variables that made up our income statement. Okay, and then actually, you can see here on column N, we've included those steps. So number one was historical financials. We calculated that. Number two, we calculated cost of goods sold and SG&A as a percent of revenue. These are margins. So margins, SG&A margins as percent of revenue. Let's zoom out a little bit. And then we forecast income statement per revenue and COGS and operating SG&A margins, okay? So the next step was to calculate our working capital ratio. So I'm just gonna write that here. Calculate working capital ratios and forecast our balance sheet, current assets and liabilities. Let's press F7 to make sure there's no misspelled words. Yes, there is. I have one, so let's change that. Pay down, we can actually have a space next to it. Yep, spacing, everything else fine. Great. Okay, folks, so now that we've covered that, let's go ahead and continue with calculating our current assets and current liabilities. So how are we going to calculate accounts receivable? So we already know it takes us approximately 37 days to convert our receivables into cash. So we have two variables. We have the turnover ratio and we have revenue, because revenue is essentially tied to accounts receivables, the portion that you don't collect in revenue. When a customer doesn't pay you in the complete revenue amount in cash, a portion of that is going to be paid at a later date, which is put on credit, and that credit amount is known as accounts receivable. Okay, so the way we're going to solve for accounts receivables is quite simple. We're going to do equals. We're going to take our receivables turnover ratios divided by 365, multiply that by revenue, total revenue. There it is. Okay, we're going to do the same approach, or we're going to take the same approach for inventory. We're going to do equals. Let's take our inventory turnover ratio days, which is 61, divided by 365, and multiply that by cost of goods sold. And of course, don't forget to either put in a negative sign in front of it or use the ABS absolute format. Okay, here we go. So let's just take the sum of all of these numbers, and it would give us our total current assets. And of course, we still have to include our cash and equivalents. So I'm just going to, for now, for the time being, I'm just going to set it equal to the previous year. And I'm actually going to remove the highlight for receivables and inventory. And I'm going to highlight my cash and equivalents because I'm going to come back to this at a later point. Okay, so I'm only highlighting it because we're going to come back to it so that we don't forget. Now, here's a short break. If you're enjoying our content, don't forget to visit our website, romeromentoring.com, and check out our starter analyst programs, where you'll learn financial modeling, investment analysis, valuation, and develop the skills professional analysts apply on the job each day. In addition to that, you'll have access to our platform and exclusive access to content relating to investing, stock analysis, opinion, and much more. Join our growing analyst community and level up your skills today. Now back to our content. So now we have our current assets. Property, plant, and equipment. The formula for this will be derived from our cash flow statement. So for now, let's go ahead and set it equal to the previous year, just the same way we did for cash and equivalents. And let's go ahead and highlight property, plant, and equipment. And we'll talk about this a little bit down the road. And my total assets will be total current assets plus net property, plant, and equipment. Okay. And let me actually expand the columns here. And I think that's good spacing. Now let's go ahead and continue with the liability side of our balance sheet. So taking into account the same approach, the same methodology that we did to solve for inventory and receivables using our working capital ratios, it's the same approach for accounts payable and accrued liabilities. So let's come down here. Here we are, and calculate accounts payable. So we're going to do equals our accounts payable turnover days divided by 365, because that's how many days there are in a year, times cost of goods sold. Okay, and of course, let's not forget to put in the dollar sign. Now, if you don't understand why we're doing this, why we are multiplying by cost of goods sold, this is what you learn in Principles of Accounting or in Accounting 101. The reason we're doing it is because there is a direct relationship between accounts payable and cost of goods sold. Remember, cost of goods sold are the expenses associated with you buying the raw materials, the supplies that you need to create your product or service. When you purchase your raw material and supplies, you typically purchase it from the supplier. The supplier would send you the supplies and the raw materials, but you would pay them at a later date. Therefore, you creating a liability for yourself. That's what accounts payable is representing. And these are just things that you pick up once you take Accounting 101. All right, but I just want to give you a little bit more color and transparency so that you can connect the dot and understand the relationship a little bit better. So let's continue with accrued liabilities. So following the same format or the same approach, we're going to take accrued liabilities turnover ratios divided by 365 times SG&A. And where's my SG&A? Here it is. Okay, and of course, I'm going to put in a negative sign. And my short-term debt, we're just going to flatline this. And short-term debt and actually long-term debt, which you're seeing in row 48, these two are typically forecasted in something that's known as a debt schedule. The debt schedule would take into account how much cash we have available to pay down the debt after paying dividends, after paying our CapEx, and any other type of working capital expenses associated with the business. So essentially, you're left with what is known as your free cash flow. Free cash flow available to service debt is what we would use to pay down short-term debt and long-term debt liabilities. For simplicity purposes, we're not going to do a debt schedule. That is something that we actually do in our analyst prep program. And I just wanted to give you a little bit more color so that you understand that in a normal model, when we're dealing with an actual publicly traded company or even a private company, there's ways of forecasting short-term debt and long-term debt. And this is known as a debt schedule. So I just wanted to give you a little bit more transparency on these numbers, because right now we're just going to flatline it. And when I flatline a number, I'm just setting it equals to the previous year, and I'm going to drag it across and keep it consistent. Okay. It's in some cases, it's best practice to apply this approach for other line items on your balance sheet, but traditionally not for short-term debt or long-term debt. If you are in investment banking, you would have to actually forecast in your debt schedule long-term debt and short-term debt. All right. So let's continue here. So for now, we're just going to flatline it. Let's calculate our total current liabilities. We already have accounts payables and accrued liabilities for 2019. Let's remove the highlight. And of course, long-term debt, we're going to flatline that as well. My total liability is total current liabilities plus long-term debt. There we go. And for my stockholders' equity, same approach that we apply to short-term and long-term debt. We're just going to set it equals to the previous year, and we're going to flatline it. Common stock, here we go. Paid in capital. and retained earnings. Now, retained earnings, I will highlight this number because this number is impacted by net income. And we're going to come back to that number once we get to the cash flow statement. So let me scroll down, zoom in a little bit more so that's easier for you to see. And lastly, let's calculate total stockholders' equity. Total stockholders' equity just takes into account all of the line items that makes up your holders' equity or your stockholders' equity schedule, which is common stock, paid in capital, retained earnings. And in some cases, if you're buying back shares, you'll see something known as treasury stock. Okay, so here we go. And my total liabilities plus stockholders' equity gives me my balance sheet number for liabilities and equity side. Now let's calculate the check. Do we balance? So equals total liabilities and stockholders' equity minus total assets. Look at that. We don't balance. We don't balance by 40. But let's see what happens if we drag all of this across to the right, all the way out to 2023. Control R. Okay, so notice that my check balance is compounding. It is growing by 20. So something is obviously off here in our 2019 financials. Because if we've done it correctly, it would match and it would be 0. This right here is one of the most challenging, most annoying, and tedious tasks that just quite simply gives first-year analysts headache, figuring out how to balance their balance sheet. Now imagine if you're working on a live transaction and you have a model that is a lot more complex than this one. How complex? Well, let's take a look. There's 90 rows in this particular model. When I was an analyst, I was working with models that had about 900 rows. Not only that, there's only, how many tabs here? 1, 2, and then there's a sheet number 3, which is empty. I would sometimes have 20 tabs. And imagine building a model so complex where you're not only forecasting the financial statements for each financial statement, but you're also running multiple scenarios like buying back shares, spinning off an asset, using the proceeds to make an acquisition, or recapitalizing the balance sheet. And then on top of that, do a merger model and an LBO model and then perform valuation under each and every one of those scenarios. That's the technical side. But then you also have to present that in a presentation that has to be free from error, well formatted, client ready, and professional. And all of that is due by tomorrow morning, 7 a.m. because we have a client meeting at 8 a.m. This is the reality of investment banking, the day-to-day life of an analyst within their first year. So I hope that kind of gives you a little bit more perspective and insight into what the lifestyle of a first-year analyst is. And those first 6 months, to a year, you're focusing a lot learning all of these skill sets, the soft and the hard skill sets, because these are the unfilled gaps that you had during college at the undergraduate level. And the only ways for you to fill these gaps is obviously by doing exercises and programs like this one, perhaps taking it upon yourself and taking responsibilities to watch all their videos so that you can practice and master these technical skills, which you're only going to learn with more practice. And then obviously, if you get into an internship and someone gives you the opportunity to build a model like this, but chances are they're not going to trust your work, so they're not going to give you these exercises. So you are responsible for finding programs that would teach you these things before you even start working as a full-time analyst. And the reason why this is important is because within those first 6 months on the job, if you haven't developed these skill sets, if you don't have a high level of understanding of what's going on with that client and the situation, and then be able to build a model, put together a nice presentation, you're going to be catching up to other analysts that already know this. And when your performance evaluation or your performance review comes up, you're not going to be ranked top analyst. You might be ranked mid-tier or low-tier analyst. And that's the difference between you getting a $100,000 bonus or a $30,000 bonus. That's a $70,000 difference. So you tell me, is it worth investing in your education now that it's early? Or is it not worth it for you to just go 4 years of your undergraduate career and then learn this on the job? If you wait until you get the job and then you're learning on the job, guess what? It's going to cost about $70,000. It's going to also cost you perhaps your reputation It might slow down your learning curve. And it's also going to cost you with exit opportunities when you want to go to from the sell side to the buy side, because the top 10 hedge funds, the top 10 private equity firms, they only want to recruit analysts that are ranked top analysts, and they're essentially top tier number one. And the pay raise for those analysts, it's a lot higher. So at the end of the day, we're talking about saving time and making a lot more money. So you have to make the time, you have to make the investment on yourself now. It's highly critical. And I hope that example right there amplifies the importance of it, right? It should just really be emblematic of what I am trying to teach you and the message that I'm trying to get across. So with that being said, let's go back here to the model. So we don't balance by 20. How can we figure this out? Well, I'll walk you through a very simple, quick way of figuring it out. So we need to find which line item over here has a change or a variance from 2018 to 2019 of 20. Let's go to column N, and let's calculate the change for from 2019 to 2018 for each individual line item. So look at that. So the change here for cash and equivalents is 0. Let's scroll down. Look at the change for receivables and inventory. Okay, so we have changes there. What about total current assets? So we have a change there. Yep, it's 30. We don't have any change for project, plant, and equipment. For total assets, it's 30. All right. What about for the liability side? Look at that. We have 20 for accounts payable, and we have 30 for accrued. And if we keep scrolling, if we just drag all of this down, 0, 0, total liability, 0, 0. Okay, so we can easily see that the changes are coming primarily from our working capital lines, right? And that's right here. Actually, we should even remove total current assets because the main changes are just these two line items. That's what's driving our total current assets. So accounts receivable and inventory. And then, of course, we have it for accounts payable and accrued liabilities. Those are the only two sections within our financial statements that are changing. So we need to account for this in the cash flow statement, in something known as our working capital, net change of working capital. So let's go down here to our cash flow statement. So let's go ahead and see if we can balance this balance sheet first by accounting for those changes like we have right here. So let's go ahead and do that. Let's start first with accounts receivables. So we're going to do equals. For accounts receivables, the formula will be, we're going to take the previous year, 2018, minus the current year, 2019. Notice we have a minus 20. There's a reason for that. Let me explain. When your accounts receivables, when it increases from one year to the next, it means that your receivable increased by 20 in this particular case. That means that a customer bought one of your products, but decided to pay you at a later date. How much? 20. That 20 that they're going to pay you at a later date, it's what's increasing your accounts receivable. It's otherwise known as credit, okay? That's why you're seeing here it's reflected as a negative sign because you didn't collect the cash. Although your receivable is increasing, it's cash that you didn't collect. That's why I put this formula this way, and that's why it's displaying a minus 20, okay? Let's do the same thing for inventory, equals. For inventory, it's going to be the previous year minus the current year, and same thing, minus 10. Why? Because our inventory increased. If our inventory increased from one year to the next by 10, that means that I spent about $10,000 buying more materials, more supplies, which is now sitting on the warehouse. But did I pay that on credit or did I pay it in cash? Well, here it is. It's paid in cash. So although my inventory increased, that means it was a cash outflow because I bought more supplies or raw materials. For accounts payable on the liability side of the balance sheet, the formula is different. We're going to do equals the current year minus the previous year. Enter. And there it is. It's 20. Why is it 20? Because my accounts payable increased by 20, which essentially means that I bought raw materials and supplies from my suppliers, and I added an additional 20 to pay at a later date. So that 20, I will probably pay them in approximately, if we look at our at our accounts payable ratio, in about 122 days. And because I'm going to pay them at a later date, that is money that did not leave the business. That's why it's reflected as a positive on the net change of working capital. And lastly, accrued liabilities, which follows really the same logic. We're going to do the current year minus the previous year, and that should also be a positive number. There it is. If we take the net from our changes in working capital, it's 20. If you see our balance sheet, why it doesn't balance, let me pull up here our mark. This 20 is because of this 20. We need to adjust what? Our cash and equivalents need to be reflecting that 20. And we're going to do that right now. So let's scroll down. Let's calculate my cash flow from operating activities, which is going to be equals net income, depreciation, plus my net change, okay. My cash flow from investing activities, okay. We have financing activities, and then we have cash, changing cash for the period. Changing cash for the period takes into account the 3 parts of my cash flow statement. Again, if this is new to you, don't worry about it. If you're a freshman, if you're a sophomore and you haven't taken accounting and you plan on taking accounting, you're gonna learn these things, but this is just more of a refresher and introduction for you at a very high level. So again, don't worry. Just know that a cash flow statement has 3 sections: the operating activities, the financing activities, and the investing activities. And when you add the sum of each one of those sections, you get what's known as your change in cash and equivalents for the period. That's what this is, changing cash. We could change it to changing cash and equivalents. Okay, so easy fix. So when we take the sum of all of this, we get minus 480. But you know what? Let's go ahead and zero out our CapEx, right? We're going to come back. CapEx is going to be 500, but for now, let's zero this out. I still want to make the relationship between my cash and equivalents and the balance sheet, why we don't balance. So you see here this 20, okay? When we look at our cash from operating activities, as it stands, our cash flow statement is saying we increase our cash by 20. But we need to come back here to the balance sheet and look at the cash and equivalents. Now we need to adjust it with the cash flow statement. So how do we make that adjustment? We do equals. Set your cash and equivalents to the previous year and add it or add your cash change for the period. Hit enter, and you better hope and pray that your balance sheet balances for that period, and it does, 0. Now, let's go ahead and drag this across all the way to the right, and let's remove the highlight because we already adjusted this, and because this is a formula, it should be black fonts. And actually, here's the cover page in terms of legends and what the colors mean. So red means an external link. I'm linking to another sheet or another file. Green means links when I'm linking to another cell. Hard codes, it just means it's a variable. It's a number that is driving perhaps another cell. And black is formula. This is universal on Wall Street or internationally. Okay, so let's continue. And we balance. So now we've done balance for the other years. That's a simple fix. Drag your net change in working capital and your cash flow from operating activities to the right. And look at that. It's like magic. Let's do that again. Undo, Control Z, and Control Y to repeat the previous action. Look at that. It's like magic. It's good. But once you get your balance sheet to check like this, there should be a sense of relief, a sense of satisfaction. It's like a lot of people are clapping. But believe me, you may not find it amusing, but if you do get to do investment banking, or if you become an intern at an investment banking firm and they give you this as a test, believe me, if it was the first time you're doing it and you're trying to figure it out and you manage to do it on your own, it's a feeling of satisfaction and rewarding, because you're proud of yourself, because you were actually able to do something on your own that many people would not be able to do if this is the first time they're being exposed to modeling, okay? And at least that's how I felt when I was an intern my junior year and I was interning in M&A. So let's continue, okay? So now that we have our balance sheet to balance, now we can go ahead and add back our CapEx, which was minus 500, drag this across to the right. Notice that we don't balance by that 500 number. Why? Because it's trickling down. So this 500 is impacting the cash flow from investing activity. Let me drag this down, which also impacts my cash and equivalent. And you see here my balance sheet now is not balancing by that 500. It's compounding. So we need to make the right adjustment on the balance sheet. So remember, your CapEx is the amount that you are investing in your operations to maintain your plant and equipment. So if there's any upgrades, repairments, if there's any changes in pieces or equipment. That's essentially what your CapEx is. So when you invest in CapEx, guess what? It increases your property, plant, and equipment. So that is the actual line item that you should be adjusting. How do we make that adjustment? Simple. We do equals. We take the previous year balance and we add back, actually it should be a minus sign because negative and negative is a positive. We add back our CapEx. If we enter, look at that. We balance for 2019. So now we just need to drag this number across to the right. My net PP&E from column G, let's drag it across. Control R, and we balance. Again, it's like magic. It's a beautiful thing. There we go. And the last point here that we're going to focus on is populating our net income. Okay, so net income is coming from my income statement. And let's take my net income balance number. Here it is. Drag this across to the right. This is a link, so we're going to make this green. There we go. Notice that the balance sheet doesn't balance by my net income amount. Why? Because the net income, as soon as I add the net income to the cash flow statement, it increases my operating activities, my cash flow from operating activities, I should say. And it also increases my cash and equivalents, which has a direct correlation with the balance sheet on the asset side. So now I need to adjust the liability and stockholders' equity side. Where do we adjust net income on the balance sheet? That's a very simple interview question. But because we're doing this exercise, the answer is simple, is on your retained earnings. This is where net income is accumulated over time, which accounts for any type of historical earnings that the business has generated. It's right there in retained earnings. Now, let's say that some of you guys want to perhaps someday embark in entrepreneurship and you want to buy a business. You want to buy a restaurant. You want to buy a dry cleaning business, a convenience store. It doesn't matter. When you look at the financials and the owner of that business, the owner that is selling the business says, yes, my business makes about $300,000 a year. Oh, great. Let me see the financials. One way for you to verify. And if that is correct, it's right here. Look at your retained earnings. And that number should at least show at least $300,000. Why? Because if the owner is telling you that this business generates $300,000, you know accounting. He probably doesn't know accounting. But when you look at the financials, you can kind of do a little forensic accounting and see if over the last 3 years, he tells me that the business was generating $300,000, then net income should be $300,000. So the retained earning every year should be adding $300,000. So after 3 years, you should have $900,000. If that's not the number, then there's something off. There's something missing, okay? This is the level of sophistication and understanding that you develop the longer you do this, okay? So let's go ahead and link or adjust my retained earnings. So it's the previous year plus net income from the cash flow statement. Oh, we balance, drag across to the right. Again, it's like magic. It's a beautiful thing. There we go. And lastly, what else we have here on our cash flow statement? We have depreciation, okay? For simplicity purposes, we're gonna leave depreciation 0. Again, this is something that we actually cover in the analyst program, which we go a lot more in detail than what you're seeing right here. And also you'll learn it more in accounting, or you can even find other free sources available to you, like in YouTube or on Google, if you really want to develop this level of skill set and understand it a little bit more. All right. So as it stands right now, our model is almost complete. Okay. We need to calculate now what else is remaining? This, our interest income. Now notice that in order to calculate my net income correctly, what do we need? We need interest income. Okay. But we haven't calculated interest income. What is the first line item of the cash flow statement? Is net income. Net income trickles down to what? Your changes in cash and equivalent, which what? Impacts your balance sheet. So now you begin to see that whole circular motion, or the relationship and connection within these 3 financial statements, okay? So let's come over here and create a little schedule and add, let's see, beginning cash balance, okay? Changes in cash and equivalents, and then ending balance. Okay, so for 2018, what was the ending balance? Let's link this from our balance sheet number because we have it up here. What is my beginning balance for 2019? There it is, $2 million. What is the change? There it is. What is my ending balance? Okay, let's drag this across to the right. Let's add a borderline. And now what are we going to calculate? We're going to calculate our interest. Or we should say, that's fine, interest rate and interest income right here. So the interest rate, let's just take, I believe the current money market accounts is about 0.5% or 50 basis points, okay, which is not a lot really because of the current environment. Interest rates are rather low. How are we going to calculate interest income? We take the average between my beginning and ending balance, and we're going to multiply this by my interest rate. I'm going to anchor this cell, drag this across to the right. So essentially, this is assuming that every year, because we have on average, if we take the average of these two, you probably have about $3 million of cash sitting in your bank. You're going to be earning 50 basis points. That's about $14,000 of interest income a year. Now, this number needs to be included in my interest income line on the income statement. And once you do this, now you begin to have a fully circular model. But pay attention to what's happening in Excel. Notice that we have a circular reference warning. This happens because we have circularity or circulation within the model. Essentially, we are making an illogical calculation. What does that mean? It means that you need to arrive to X using the same variable X. So how can you solve for X when you have X? You're self-referencing to a cell to arrive to the same number. It just doesn't make sense. It's irrational. It's like, what comes first, the chicken or the egg? So that's really what's happening here, and that's why you're getting the circular reference warning. How do you fix that? Simple. Click OK. You're going to get these retracements, okay, these blue lines. And the way you fix this, let me clear up my screen here with my drawings. The way you fix this is you go to Excel options. You go to formulas. You see here on the right-hand side where it says enable rate of calculation, make sure this is checked. This tells Excel that, yes, I want to make this calculation. It's intentional. So please calculate it for me and give me the answer. Okay, but as you're doing that, make sure you do the calculation at least 100 times, and you give me the numeric value closest to the 100. What is this? Ones, tenth, hundred. Yeah, to the closest to the 100th decimal place. So this is essentially what you're doing, and you have to instruct Excel to do that. That's why you have to check enable rate of calculations. So if we click OK, it's removed. Let's drag this across to the right. And now you have a fully circular model. That's what this means, folks. Here it is. And you can run this simple exercise perhaps on any business. It could be a grocery. It could be a dry cleaning business. It could be a service business, a packaging business. It doesn't matter. It will still follow this format. The only thing that might change is the line items, right? You might have multiple line items here, right? You might have multiple line items. And it doesn't matter because we still have the same format. And now you understand how to calculate your current assets, how to forecast your current liabilities, and you might probably have a couple of more line items over here, the way I showed you in the previous lecture with the Chipotle income statement. It's still the same thing. So don't let the level of complexity, the line items confuse you. Follow the format and just apply the same principles. What's really hard about modeling is not being able to make these calculations. That is not hard. What's really hard is this, figuring out what is your assumption. That's the hardest part of modeling, okay, is this, your drivers. That's what's hard to figure out. And to take it another step further, breaking the business into sections where you understand how they make money and what are all of the variables that you have to account to really understand this business or run it in an efficient manner. Then you get into situations where you have to create revenue buildups. What does that mean? Well, if this was a subscription-based business, or if this business where we have here volume, what if as part of this volume, this company had about 20 different products, 20 different SKUs, and they sold in about 7 or 8 different states? How would you create a revenue model a revenue buildup model that's a lot more detailed and more accurate? Well, the way you would do that is you'll come here, okay? You'll probably put volume products, and then you'll probably be category, and then you'll probably have one. If this was a company with 10 different products, then you need to have breakdowns for each and every one of those products with your own assumptions, the target market area, market penetration. So I think you get the point that you can make this model a lot more complex. This is what's hard about modeling. It's about learning the business. It's about understanding all of the different components. What makes it work? How do they use their marketing strategy, their advertising? What is their pricing strategy? What is the culture of the organization? What systems do they have in place to check that everything is running efficiently? Is there any leakage or bottlenecks within the organization where they're actually losing money? That's what's hard, okay? So with that being said, in terms of final steps, what did we do here? So let's recap. I think it was a couple, 2 more, 3 more. So we calculate, okay, so forecast the balance sheet. What did we do after that? After that, we reconcile the cash flow statement with the balance sheet. And let's see, is this spelled correctly? Reconcile? I'm a terrible speller. Okay, there, great. So we reconcile the cash flow statement with the balance sheet. Then we forecast. What did we forecast? I believe it was CapEx and adjusted with PP&E, property, plant, and equipment. We forecast net income and adjusted with retained earnings. Okay, and the final step was what? Link interest income to the to the net income under, no, this is fine. So link interest income to the net income. That's it. So you can really boil down this model to 9 steps. All right. All right, folks. So I hope this was helpful. I hope this gives you more of a better understanding of financial modeling, the structures, the steps. I know this is quite simple. For those of you, if it's the first time and it might seem like a little bit challenging, I really try to simplify this to give you a framework of what modeling is all about. Now, of course, this is just a simplistic representation. It gets a lot more complex than this, believe me. And an example that I tried to illustrate was here with different products. If a company had 10 different products serving multiple states, then what is the economics of each one of the products? What is their marketing strategy? What is the penetration? What is the pricing strategy? What if it's a SaaS? I mean, I can keep going on and on and on to help you understand how complex business gets. But that's one of the things that we review and assess in the Analyst Prep program, which is, again, it's a little bit more in-depth and more competitive for those of you that want to take it to the next level and really understand this the way a full-time investment banker would. So with that being said, folks, I hope you appreciate this. I hope you found this educational, and I hope it added value to your time. So with that being said, I'll see you in the next lecture where we're going to focus a little bit more on valuation. So now that we built the model, how do we use it? How do we value a business? That is going to be covered in the next lecture. DCF, comparable company analysis, and any other type of valuation methodologies. All right. So with that being said, take care, and I'll see you guys in the next lecture. Bye-bye.